stop scrolling, stop whatever you're doing, let's start. For the better part of a decade, the financial establishment treated the digital asset ecosystem as a casino. It was viewed as a place of speculative excess, completely detached from the real mechanics of the global economy. But while retail investors were fixated on daily price charts and volatility, the underlying infrastructure of global commerce was quietly being rewired. The divide between the banking system and the blockchain is not just thinning, it is dissolving. We have reached a mathematical tipping point in adoption where the question is no longer if crypto will integrate with the dollar system, but what the world looks like now that it has. In this video, we are going to look at 3 specific developments that signal the end of the speculative phase and the beginning of the structural phase. This is how money actually changes hands in the next cycle. To understand the magnitude of what is happening in the payment space, we first have to look at the permission structure that governs it. For years, the greatest headwind to institutional adoption wasn't technology, it was regulatory ambiguity. Corporations, specifically those governed by strict risk mandates, simply could not touch the asset class. That era is concluding. The first signal came from MSCI, a titan in the world of equity indices and portfolio analytics. Their decision to not explicitly ban firms holding crypto treasuries from their indices is a subtle but profound shift. It essentially validates the strategy employed by firms like MicroStrategy. It signals to every CFO in the S&P 500 that holding digital assets on the balance sheet is no longer a disqualifying event for institutional inclusion. This institutional green light is compounded by the shifting political landscape in Washington, with the Securities and Exchange Commission transitioning toward a leadership structure that is overwhelmingly Republican. The regulatory hostility that defined the previous cycle is expected to evaporate. We are moving from a regime of regulation by enforcement to a regime of clear market structure. This matters because capital creates gravity. When regulatory friction is removed, capital flows down the path of least resistance. We are seeing a pivot where the largest financial entities in the world, from credit card giants to global payment processors, are no longer experimenting, they are deploying. The narrative is shifting from digital gold to digital cash. And this transition is being driven by 3 specific trends that most investors are overlooking in favor of price action. The first major development concerns the plumbing of the internet economy. Stripe, the company that effectively powers the transaction layer of the modern web, has entered a strategic partnership with Crypto.com. Beginning in January 26, this collaboration will allow users to spend their holdings directly at merchants powered by Stripe. On the surface, this sounds like another pay with crypto headline. However, the strategic implication here lies in the settlement layer. Historically, spending crypto was a tax nightmare and a logistical burden. You had to sell the asset, convert it to fiat currency, withdraw it to a bank, and then spend it. Each step incurred fees and, more importantly, triggered taxable events and time delays. The Stripe integration removes the need to convert to fiat first. It streamlines the process. But look deeper at the incentives for the merchant. Merchants using Stripe can now accept digital deposits alongside fiat deposits, leveraging Stripe's improved settlement tools. This is crucial because it solves the unit of account problem. Merchants generally do not want volatility. They want dollars or euros or pounds. By integrating at the processor level, Stripe absorbs the complexity. This partnership opens the door to the Fortune 100. Over half of these major corporations use Stripe. By flipping a digital switch, trillions of dollars in potential payment volume suddenly become compatible with blockchain rails. This is the convergence of the legacy financial system with decentralized liquidity. It is not a replacement of the old system, it is an upgrade to its operating software. The second trend moves us from corporate payments to the creator economy, which is arguably the fastest growing sector of global GDP. Tether, the issuer of the world's largest stablecoin, USDT, has partnered with Rumble, the video platform. This partnership involves the integration of a non-custodial wallet directly into the Rumble interface. This is the first live use case of the Tether wallet development kit. Why does this matter? Because it bypasses the traditional banking ad revenue model entirely. In the current model, a creator relies on a complex chain of intermediaries, banks, payout platforms, and currency converters to receive their earnings. Each intermediary takes a cut, and each has the power to freeze funds. By integrating a non-custodial wallet, the transaction becomes peer-to-peer. The platform pays the creator directly in a dollar-equivalent asset, and the creator holds the keys. With a market capitalization exceeding $180 billion, Tether has effectively become one of the largest purchasers of US Treasury bills in the world. This gives them immense geopolitical weight. Critics often focus on the risks of stablecoins, but they miss the utility. In emerging markets where local currencies are failing, USDT is the de facto savings technology. By integrating this liquidity into a major media platform like Rumble, Tether is creating a closed-loop economy. Users can tip creators, and creators can pay for services, all without the money ever touching a traditional bank account. This is a direct challenge to the SWIFT network's dominance over small-value global transfers. It represents the dollarization of the internet, independent of the Federal Reserve's direct oversight, but ironically supporting the dollar's global dominance. The third trend creates a bridge between the new world and the old. Following the collapse of FTX in 2022, Visa and Mastercard largely retreated from the sector publicly. They went dark. But internally, the research and development continued. Now they have returned with vigor. Visa recently released data showing a staggering 525% increase in spending on Visa-issued crypto cards in 2025. EtherFi led this charge with over $55 million in annual spending. This statistic is vital because it reveals a change in consumer behavior. In the previous cycle, crypto was something you hodled, you held it, and hoped it went up. The dramatic rise in card spending suggests that users are now comfortable using these assets as a medium of exchange. They are living off the yield or the liquidity of their portfolios. The credit card networks are masters of the last mile of finance. They control the point of sale. By integrating blockchain payment solutions and stablecoin settlements, Visa and Mastercard are ensuring they remain the gatekeepers. They're essentially saying, we don't care what asset you use as long as it rides on our rails. This creates a powerful feedback loop. As spending increases, merchants see more volume coming from these channels. As volume increases, the demand for stablecoin liquidity rises. As demand rises, the issuance of stablecoins increases, which in turn leads to more US Treasury purchases. It is a machine that reinforces the dollar while modernizing the technology used to move it. There is a deeper dynamic here that mainstream narratives often miss. When you combine these three trends, Stripe's merchant integration, Tether's media integration, and Visa's retail integration, you begin to see the outline of a new monetary architecture. Most analysts look at these developments and see adoption, but the hidden layer is about velocity. In the traditional banking system, money moves slowly. Settlement takes days, T+2. This latency creates risk and requires massive amounts of capital to sit idle as collateral. In the crypto-integrated system, settlement is near instant. Money becomes programmable. What we're witnessing is the commoditization of banking services. If a non-custodial wallet on Rumble can function as a bank account, and a Visa card connected to a DeFi protocol can function as a checking account, and Stripe can process the payments, the traditional commercial bank is disintermediated. They lose their monopoly on the customer relationship. Furthermore, this shift has profound geopolitical consequences. We are moving toward a world where money is no longer defined by the sovereign issuance of a central bank alone, but by the network effects of private issuers like Tether or Circle running on public blockchains. The United States government, through the new political alignment in the SEC and Congress, appears to have realized that it is better to co-opt this technology than to ban it. By allowing US companies like Stripe and Visa to integrate these rails, and by allowing stablecoins to proliferate, the US ensures that the digital economy remains denominated in dollars. It is a play for monetary sovereignty in the digital age. The risk is no longer that crypto destroys the dollar. The reality is that crypto is becoming the primary transport layer for the dollar. Integration of crypto payments into the global financial stack is not happening with a bang, but with a series of partnerships and regulatory approvals. It is happening in the terms of service updates of major credit card companies and the back-end code of payment processors. We are approaching a future where the average user will not know, and perhaps will not care, that their transaction was settled on a blockchain. They will simply know that the payment cleared instantly, that the fees were lower, and that their access to the global economy was seamless. The investors who understand this are not looking for the next meme coin to gamble on. They are looking at the infrastructure plays that facilitate this transition. They are watching the bridges being built between the island of crypto and the mainland of global finance. In the end, this isn't about markets going up or down. It's about understanding that the definition of money itself is being rewritten in real time. The system isn't just growing, it's evolving. And as always, the rewards will go to those who recognize the new machinery before the rest of the world realizes the old machine has been turned off.